A $75, that's a number that shattered the illusion of control on Wall Street. Overnight, silver didn't just rise, it exploded. Markets everywhere screamed in disbelief, algorithms collided, and the titan JP Morgan, long thought untouchable, found itself staggering, vulnerable, exposed. Black Monday isn't just a date on the calendar, it's a warning, a cinematic collapse unfolding in real time, a high-stakes thriller where ordinary citizens, retirees, and savers are the unseen victims. Imagine sitting at your breakfast table, checking your portfolio, and seeing numbers jump so violently they seem impossible, and yet there they are, your carefully built retirement fund teetering on the edge of chaos. The mechanism behind this isn't speculation, it's financial engineering gone awry. For years, JP Morgan and other major players built massive short positions on silver, betting it would remain suppressed. These positions weren't small, they were enormous, leveraged with derivatives and paper contracts that represented far more silver than existed in physical form. Every $1 increase in silver forced margin adjustments, requiring more capital to maintain positions. This is the essence of leverage. Small movements can spiral into catastrophic consequences when the underlying position is massive. And this $75 gap up didn't rise gently. It erupted like a volcano, triggering a domino effect that even the most sophisticated risk models couldn't contain. Let's break it down mathematically. Picture a short position of 100 million ounces of silver at $25 per ounce. At $75, the value difference is $50 per ounce. Multiply by 100 million ounces, and suddenly the theoretical loss isn't millions, it's billions. To cover or roll over these positions, liquidity is required immediately. When liquidity is insufficient, forced liquidations occur. Each liquidation pushes the price higher, triggering more margin calls, a perfect modern financial storm. And this is exactly what happened on Black Monday, a cascade of liquidations amplified by algorithms, social media-driven retail buying, and hedge funds desperate to cover positions. The result? Chaos that no one, not even the largest bank in the world, could contain. History offers a chilling mirror. The panic of 1907, the collapse of long-term capital management in 1998, even the 2008 financial crisis, all share a common thread: excessive leverage and concentrated control. In every case, a single point of failure cascaded into a systemic crisis. But Black Monday is different. Today's markets are digital, instantaneous, and interconnected. The dominoes fall not over days or weeks, but within minutes, across continents, across currencies, and across assets, turning what was once slow-moving panic into instantaneous terror. Ordinary people watching their ETFs, retirement accounts, or precious metal funds saw their portfolios swing in ways they couldn't comprehend. The illusion of stability shattered in seconds. The government's role in all of this is equally shadowed. Federal Reserve mechanisms, emergency liquidity facilities, and executive orders governing derivatives and commodities are designed to contain crises, but they are not omnipotent. Think of these interventions as hidden trapdoors beneath a stage. In theory, they stabilize the system. In reality, when a $75 silver gap up occurs, even the most secretive and powerful mechanisms are tested to their limits. The average citizen, unaware of these systems, is left holding the bag. Savings, pensions, and life plans suddenly subject to forces beyond their comprehension. The lesson is clear. Control is always more fragile than it appears, and the next domino could fall anywhere. The metaphorical picture is terrifyingly clear. Imagine musical chairs where each chair represents stability, each player a financial institution, and the music never stops. As silver gap up forces margin calls, the chairs shrink, the music speeds up, and those who hesitate fall. Not even JP Morgan, the historic colossus of banking, can secure a seat when the rules of the game are changing faster than any human can respond. The consequences for ordinary investors are devastating. Delayed reactions, poor liquidity, and panic-driven decisions compound losses exponentially. And yet this chaos also exposes hidden opportunities. When markets move violently, temporary inefficiencies emerge. Those who understand leverage, short positions, and the mechanics of forced liquidation can position themselves strategically. Physical silver becomes more than a commodity. It becomes a lifeboat in a storm. ETFs tied to derivatives may spike or crash unpredictably, but physical ownership ensures at least some insulation from systemic collapse. Diversification is no longer just advice, it is survival. Timing is no longer a recommendation, it is critical. Every hour, every minute of inaction magnifies risk. The mechanics of this $75 spike are rooted in more than market behavior. They are tied to deeper financial strategies, including shadow banking, derivative layering, and the interplay between physical and paper assets. Hedge funds, retail buyers, and algorithmic traders interacted in a perfect storm of feedback loops. A single large buy order acted as a spark. Algorithms, programmed to detect momentum, amplified the movement, while forced shorts added fuel to the fire. The result, a cascade of buying pressure so severe that even JP Morgan's massive capital reserves were insufficient to stabilize the position. It is a reminder that even the most sophisticated financial institutions are vulnerable to rapid, unanticipated moves. Historical parallels are chilling. In 1980, silver soared from $6 to $50 in months during the Hunt brothers saga, nearly bankrupting banks and shaking markets globally. Today, with digital trading, social media amplification, and unprecedented leverage, similar moves can happen in hours rather than months. The $75 gap up is not an anomaly, it is a symptom of the system's fragility, a stress test of leverage and concentration, and a warning that systemic vulnerabilities are more exposed than ever. The human consequences cannot be overstated. Retirees watching pensions tied to metals, commodities, or ETFs may see years of savings evaporate or swing wildly in a single session. Ordinary investors dependent on Wall Street stability are confronted with a reality they rarely consider. Markets can move faster than governments can intervene. Even sophisticated institutions can falter. When giants like JP Morgan lose control, the shockwaves reach every corner of the economy. From savings accounts to municipal budgets, from private pensions to sovereign funds. The psychological impact mirrors the financial impact. Fear spreads faster than rational thought. Investors hesitate, act impulsively, or panic sell. Each action feeds into the system, creating feedback loops that amplify volatility. Chaos becomes a living, breathing entity. Ordinary citizens are trapped in this storm, often unaware of the mechanisms that govern their fate. Derivative contracts, margin requirements, and shadow liquidity. The stage is set not for recovery, but for survival, and the window is narrow. Every decision matters, every delay is costly. Silver's spike also raises urgent questions about broader financial systems, gold revaluation, digital currencies, and government-backed crypto frameworks could be next in line for similar upheaval. When leverage, speculation, and centralized control converge with digital speed, gaps and flash crises are inevitable. Ordinary citizens and small investors who believe markets are slow, stable, and regulated face a rude awakening. The structures underpinning wealth are fragile, opaque, and prone to sudden shifts. Black Monday is not a one-time event. It is a symptom of systemic fragility that can repeat across assets and sectors. Actionable lessons emerge from chaos. First, diversify not only across assets, but across asset types, physical holdings, liquid instruments, and hedges against digital volatility. Second, maintain awareness of leverage risks. Positions that seem safe can explode under sudden market moves. Third, timing is critical. The ability to act decisively before margin calls trigger forced liquidation separates survivors from victims. Fourth, recognize that government intervention, while stabilizing, is never guaranteed in real time. Hidden mechanisms may exist, but when markets gap violently, their efficacy is limited. Survival depends on anticipation, understanding, and action. This is the cinematic reality of financial markets. A $75 silver gap up transforms a predictable system into a dramatic thriller where the hero is preparedness and the villain is overconfidence. JP Morgan losing control is a spectacle and a warning, proof that even the largest institutions are vulnerable when the perfect storm hits. Ordinary citizens, retirees, and savers are no longer passive observers. They are participants, subject to forces invisible yet powerful. Understanding the mechanisms, the mathematics, and the human psychology behind these moves is no longer optional. It is essential. As Black Monday unfolded, the metaphorical trapdoors beneath the financial stage opened, algorithms roared, and panic swept through trading floors and digital networks. Every forced liquidation, every cascading margin call, every frantic purchase amplified the chaos. The music sped, the chairs shrank, and those unprepared were left scrambling. JP Morgan's temporary loss of control is a warning to the world. Markets, leverage, and centralized power are fragile. Ordinary citizens, once complacent, must now recognize the reality. The system is far more volatile and interconnected than public perception suggests. The consequences extend beyond Wall Street. Retirement accounts, small business reserves, and personal savings are all tied into these complex, interdependent financial networks. A single gap up, amplified by algorithms and leverage, can ripple outward, affecting housing, banking, commodities, and global trade. The lesson is stark. No position is entirely safe, no institution invulnerable, and no delay inconsequential. Timing, knowledge, and decisive action are your most powerful tools. Physical assets, liquidity awareness, and diversified holdings are lifeboats in a sea of uncertainty. In the end, Black Monday is more than a headline. It is a wake-up call. The $75 silver gap up is a vivid demonstration that leverage, derivatives, and concentrated positions can collapse under pressure, and even titans like JP Morgan can lose control. Ordinary citizens, investors, and retirees must treat this not as speculation but as reality. Markets are fragile, systems are interconnected, and chaos is always one trigger away. Awareness, preparation, and decisive action are not just recommended, they are essential for survival. The time to act is not tomorrow. It is now, before the next gap, the next spike, the next Black Monday.